Hello friends, I came out with second part of video for UAE Corporate Tax. In previous part, I have discussed basic crux when it is applicable, who liable to pay, and what is the tax rate. So now in this video, I discuss some more advanced level. So this video is for the purpose of free zone person what should be benefit in the free zone or main zone, whether you do business through the free zone or main zone, which location is suitable for you. So let begin discuss. So free zone is still regarded to tax if you are earning not qualifying income. So your 9% levy is without any basic exemption. So, a free zone person can be benefit from 0% corporate tax in income earned from transaction with the business located outside India, outside UAE. So, uh, transaction with business located outside UAE, income earned from a trading business located in the same or any other free zone. So 0% corporate tax may also apply to earn from certain regulatory financial services directors in the foreign market. So in this example, I cover the free zone person taxability of free zone. So UAE having presence by the Indian company has a company situated in the free zone 100% holding. So this free zone is going tax free because it is earning qualifying income. Qualifying income is 0% tax rate, but it is not. If it is not qualifying income, then 9% tax is there. So free zone person, a company registered in the free zone having a license in that particular area. So branches registered in a free zone would also be tax free. So suppose a Indian owned free zone company is dealing in the import of goods or export of goods, import of service, export of service, or some financial services for brokerage of in the capital market. That all kind of activity in the UAE free zone is not liable to tax because it is a qualifying income. So qualifying income is tax free even after incorporate of the this corporate tax. So same way, your if you are a mainland company uh, earning income from uh, free zone, your passive income is also tax free. Same way, passive income in the hand of free zone is also tax free. So what is the passive income? It is in the form of interest, royalty, dividend, or capital gain. But their trading profit, your mainland trading profit is liable to tax. Free zone trading profit in the mainland is also going to tax. So, what is the crux behind this? To prevent the free zone businesses from gaining an unfair competitive advantage compared to business established in the mainland UAE, any other mainland source income will disqualify a free zone person from 0% corporate tax regime in respect of all their income. So, suppose you are mainland entity, right? You are receiving some covered income, some kind of income from the free zone person, or you are selling goods to the a free zone person, sale of goods. So you are making payment this to the free zone person. So what is the income received by the free zone is tax free. So withholding tax rate even is zero, and your free zone person will not be liable to tax. So there is a election to tax. Suppose you are earning free zone income and main company have a profit, and in the free zone there is a loss. So this loss cannot be set off because your pre-zone losses profit is not taxed, same way loss is not allowed. So you can elect your free zone will regularly pay the taxes, right? In that scenario, your free zone would liable to tax at normal rate. So election can be made as per the article that, but this election is irrevocable. Once you opted, you cannot go back. So just for the sake of purpose to allowing these losses, you are elected to pay regular tax rate. But in case in year two, suppose you have earning this profit in the free zone, this free zone profit will again liable to tax. So we have to do systematic analysis whether we should opt out or whether we should remain in the free zone. So this is a transition period. Once we close this financial year, our financial statement, we have to do analysis for the implementation of the corporate tax. So your free zone passive income is exempt. Your transaction between the free zone and group entity is remain exempt. So your qualifying is tax 0% and non-qualifying income without any basic limit is taxed at 9%. So this is example I covered. What is the qualifying income? Suppose you are importing some goods UAE in the designated zone from South Africa. So this import in the free zone not liable to tax because it is imported, and overseas transaction, whatever transaction in this free zone is qualifying income is 0% corporate tax. VAT is also not payable since it is a custom suspension area. So second thing is when you are processing in the designated zone. UAE designated zone, these coffee beans in the production, you process this coffee in the production warehouse and the plant in the free zone. So your processing production income is also qualified as qualifying income. You will not liable to pay corporate tax. VAT is not payable in this scenario also. So transfer from one designated zone to another designated zone, any kind of business transaction will be also regarded as qualifying income, not liable to tax. Uh, but in case you produce and sell in the mainland, sale in the mainland, in that scenario, your profit will be regarded as not qualifying income and liable to tax. So UAE designated zone is having a coffee shop in the designated zone and transfer 10,000 pieces for coffee shop. So in this scenario, you have to pay custom duty. After that, you have the receiver is liable to pay VAT also under the RCM mechanism. So in this scenario, corporate tax is also paid. So in a case you are exporting some goods to outside the free zone, outside UAE, that is also covered in the qualifying income, not liability. So qualifying income is if you are maintaining adequate substance in the state, driving qualifying income and comply Article 34 arm length principle and Article 55 of this decree law and meet other condition for audit and maintenance of books of account, then your qualifying income is tax free. So this is for free zone. So there is concept for election to subject to tax as I discussed. This is the irrevocable uh, election. Once you opt out from free zone and want to pay regular tax as per this corporate tax, you can't go back. So you have to take care of this. A free zone person will at any time be able to make election to subject to pay regular tax. So now I discuss what is the tax group. Suppose you are a group of company, you are a parent company having a subsidiary presence and a wholly owned subsidiary having a state more than 95%, and your subsidiary has same financial year, right? And subsidy is also not an exempt person, not in the free zone person. So if these three criteria is passed, you can choose an that subsidy also part of your tax group. You can file a single return and pay tax at their own. So as I discussed, financial year should be same. If your financial year parent company is January to December, but your subsidiary is uh, January to this January April to March, since the financial year is differ, this is not a part of the tax group. But if your subsidiary is the same financial year but another condition is not met, since this is the 0% corporate tax levy, so this is not also part of the tax group. So financial year should be same 95% stake, and both are the taxable person, not an exempt person or located in the free zone. So tax group, basically this is discussed, I discussed in detail. So transfer within qualifying group. As I said, 95% uh, can choose in a tax group. If you want to transfer some kind of asset or liability within the group in which you are holding more than 75%, and both are taxable person, not an exempt person or qualifying person, then in that case you can transfer your asset or liability, no need to pay any tax on capital gain. So your losses can be carry forward or offset against the taxable income, but the criteria is 75% threshold limit. So a tax loss can be offset against the taxable income of the subsequent tax period to arrive at taxable income for those subsequent periods, right? The amount of tax loss used to reduce the taxable income for any subsequent period that cannot exceed 75%. So your losses is 1 lakh, but that is allowed only 75,000 offset, right? Another condition is limitation on carry forward of losses. So there should not be change in ownership more than 50%. If your ownership is changed more than 50%, your losses cannot be carry forward. So change in ownership is also covered in the article 39. Transfer of losses, you can transfer your losses to one subsidiary to another subsidiary, one subsidiary to parent entity to subsidiary. This 75% ownership criteria is there. So without tax group is requirement is 95%, but here in case of 75% common holding, you can transfer your losses to another profit making. So restructuring relief is also there. Suppose in case of merger acquisition or some amalgamation, the amalgamating company merge into amalgamated company and spin off. That kind of transfer is not regarded as transfer. So this there should not be notional capital gain in the hand of the amalgamated company. So friends, in this second part video, I have discussed the basic crux in the advanced level, how this 9% corporate tax levy will be implemented phase in the UAE. I have discussed free zone, what is the tax implication when you can elect to opt for normal levy and 0% tax liability in case of free zone.